Hey everybody, Rob Maurer here, and today, actually a pretty big news day. Kind of out of nowhere, we seem to have a new business line popping up for Tesla. We also have pretty major announcements from Ford from their earnings call. Hertz gave an interesting update on Tesla as well, and a few other items alongside those. All right, looking at the stock, another tough day today. Tesla down 3.14%, closing at $205.76. The Nasdaq also another challenging day, down 1.75%. So a little bit better than what we had seen yesterday, but it's pretty rare that we get that degree of negative days back to back. So looking at the Nasdaq, this is actually the worst 2-day performance for the Nasdaq in this year. The last time it was this poor was December 16th of 2022. So 2-day stretch here of really tough results, obviously alongside earnings reports from a lot of different companies this week. But Tesla hanging in there, I think, despite the performance, relative to Tesla's beta over the last couple of days to the Nasdaq. So we'll see after hours, a little bit of better results. Certainly yesterday we saw that trending down leading into today. Right now we're up 1% after hours after what seemed like it was going to continue. So hopefully it'll bring a little bit better news tomorrow. This morning we did have the GDP report, the preliminary release for the third quarter, and real GDP was up 4.9% with this preliminary report, so that will be revised. Real GDP is supposedly inflation adjusted. So this is a pretty strong number. That is the highest GDP increase since 2021, which I imagine those comps were boosted by, the comparisons there were boosted by COVID in the year prior. So that's just my guess without looking, but strong result there. I kind of expected that maybe the performance here would be due to higher GDP results leading to, a little bit more room to increase rates. But according to the CME Group FedWatch tool, that's not been the case, at least for today. It looks like expectations, we're just kind of looking out a few months here into January. Expectations for a pause have actually continued to increase. So that doesn't seem to be what's going on, at least in terms of today. But obviously a lot going on in the market elsewhere. So interesting to see that. But getting into Tesla specific news, very interesting update, again, kind of out of nowhere today from BP. They announced that they are going to be acquiring $100 million of fast charging hardware units from Tesla. So this is going to be the V4 supercharging hardware. This will be BP branded, as we can see in the press release. So it'll be kind of interesting that we're seeing these Tesla superchargers effectively under BP branding that BP is acquiring and then deploying from Tesla. They say in the press release that the introduction of Tesla's chargers to the BP Pulse network is the first time the hardware will be purchased from an independent EV charging network. So said another way, first time Tesla is letting other people purchase and install and manage superchargers. So with this release, they also say that, of course, these will have the output of 250 kilowatts. Hopefully we see that increase over time, as again, these look like V4 hardware, which shouldn't be surprising. They also say this will be including the Magic Dock. So it's going to have the North American Charging Standard, or NACS, and the adapter kind of built into the charging connector to allow for CCS charging as well. Now, I would imagine that this probably won't be super long-lived, at least here in North America, of course, because I think NACS is going to become predominant. Hopefully a single standard over time, but for now they are planning to move forward with that adapter built in. They also say that to further improve the user experience, the Tesla chargers will support the use of plug-and-charge protocol, which simplifies and automates payments. So hopefully this means it'll be as simple as right now plugging into a Tesla supercharger, where it'll use the vehicle to establish that connection and handle things like billing and initiating the charge. They say that as is Tesla's current policy, third-party operated ultra-fast chargers meeting Tesla's reliability and functionality requirements are featured in Tesla's vehicle UI and apps, and BP Pulse expects to uphold those requirements on its network. So essentially, as long as BP can meet Tesla's standards, it sounds like these should show up when we're doing things like navigating, and looking perhaps at different charger options in things like the Tesla mobile app. So that'll be really nice. I don't know how much hardware exactly $100 million is going to buy. They don't give a number of charging stations that they plan on deploying here, but that's a significant investment. And we'll come back to that quote there in a second. They said in February that they're going to be investing $1 billion just in America's EV charging infrastructure by 2030. So what we're seeing here with this $100 million investment could just be, sort of stage one of a multi-stage investment from BP just with Tesla just in the US. So over time, we could see other companies join this, do similar things. That we've clearly seen the dominoes fall quickly for the adoption of the North American charging standard. We could see similar dominoes fall quickly with fueling companies wanting to follow BP and not get left behind with the deployment of this charging infrastructure. So it could become a situation pretty quickly where Tesla is supply constrained on producing this hardware. Presumably Tesla will be the preferred partner here. We've talked before with the new energy vehicle or the National Electric Vehicle Infrastructure funding that Tesla's costs for their bids on those projects are well below other competitors trying to install projects as well. It looks like roughly 50%, probably even a little bit more than that. So if Tesla is able to supply this at scale and at a much cheaper cost than competition, this could be actually a very significant, potentially multi-billion-dollar business for Tesla, as kind of crazy as that sounds, maybe over multiple years. But again, this kind of just looks like a first stage. So interesting to see this. Of course, the rest of the relationship, I would imagine that BP is positioning themselves to be able to, profit off of the sale of the electricity. Otherwise, it probably wouldn't make a ton of sense for them to make the investment. So I don't expect outside of any potential hardware margins that Tesla would stand to benefit from this. Maybe they build something into the contract where they get a little bit of it, which would be awesome. But it's not something that I would have maybe huge financial projections for, again, outside of hopefully at least a little bit of margin on that hardware sale. Because again, Tesla's probably going to be supply constrained here, and Tesla can deploy these stations themselves too. So integrating this with BP, there's got to be at least some incentive to do that, which I think Martin Viecha, Tesla's head of IR, touched on today. On X, he said, this is a big deal. ICE car drivers will get to see fast chargers wherever they refuel at BP-owned stations, which is great for EV transition. On top of that, more fast chargers for EV owners. It's such a win-win. So fully agree with that, and the point is well made about, when you're driving an ICE vehicle and you're filling up at a BP station, if you're seeing constantly people being able to charge their electric vehicles, you lose a lot of that range anxiety that maybe exists before you're willing to make that leap into an EV. So exciting to see that. And then also they mentioned here that as part of the National Electric Vehicle Infrastructure funding, when we've looked at those projects, BP is actually one of those other companies that is getting funding. So although Tesla is somewhat limited in terms of the maximum amount of funding that they can get in each state, some of them have limits on 25% of their budget can go to one company. With some of that funding then going to BP and BP then paying Tesla for the hardware, that I wouldn't say necessarily like circumvents that rule, but it does mean that Tesla is able to reap the benefit potentially from those other companies and the funding that they're being granted through this project. So again, that's sort of something that will be deployed over the next 5 years, and it should be pretty significant over time. Small start initially in the few states that we've talked about so far, but that will grow to be pretty significant over time. So then just quickly looking at a quote here from Tesla. So Rebecca Tanucci, who we frequently hear from, she presented at Investor Day relating to these sort of charging updates. She said that selling our fast charging hardware is a new step for us and one we're looking to expand in support of Tesla's mission. So again, $100 million here, nothing small in terms of Tesla's overall revenue. It's a small chunk though, but should be something that grows over time and hopefully just one of, again, future dominoes that we'll see fall. So good for BP on that. And again, we'll continue to keep an eye out and see if another company wants to follow quickly. All right, next we've got confirmation here from Tesla on their Weibo account that deliveries of the new Highland Model 3 have commenced in China. So of course, we have seen over the last few days, these start out in Europe, China now beginning deliveries as well. So exciting to see that. When we see insured vehicle numbers for this next week, hopefully we see a little bit of a bump there with these sort of being unleashed. Although I would keep my expectations lower for that first week. And then, hopefully in the coming weeks, we'll continue to see that Model 3 start to contribute more significantly. So good to see that. And then somewhat relatedly, Green the Only on X, who often finds hidden details in Tesla's firmware, has said that there are going to be 2 versions of the refreshed Model 3, Base and Sport. He says that the Sport version will have different front seats with bolstered side support and headrest, and the refreshed 3 will have different rear bench seat. The middle seat will have a headrest. So you can see the comparison photo here. Easy to look and see the old one with the stocks, also the dash. and just notice some of the comparisons between the two. There's the headrest that he was talking about. In terms of the sport seats, I'm not sure that we have a comparison photo of those, but we do know from previous information that there are differences between the rear-wheel drive version and the all-wheel drive version. I think speaker count is among those things, and it sounds like some differences with the seats potentially as well. And then he also noticed a little bit of a different update to the manual door release hatch, or door release in the rear of the Model 3, and then also says that the Model S and X are getting the ambient or interior LED lighting that we have seen in the Highland Model 3 and the updated Model Y in China. So that's coming soon. Not a Tesla app also says that their sources have confirmed that, and they say that the sort of upcoming mini refresh that would do that for the S and the X would also include the front bumper camera, which the jury is still out on. Of course, we've seen that pop up in the Highland renderings or the Highland renders on the web pages when that first released, and then they kind of removed them. So still a little bit unclear. I think Tesla's still figuring that out, but sounds like that could be coming soon for the S and the X. And then what we're seeing here is a render for the Cybertruck that is starting to show up now in the firmware. So not too much to make from that, I don't think, but kind of a cool look and a nice milestone to see that start to show up ahead of deliveries. All right, next we are getting into a few Ford updates. So we continue to have a pretty significant amount of industry-wide news this week. This time from Ford, just an update from UAW. They posted late last night that their national negotiators reached a tentative agreement with Ford. So we talked about that yesterday, but that has now been announced by the UAW. Of course, that will still need to be finalized and ratified by the UAW, so we'll keep an eye out for that. But again, those dominoes will probably fall pretty quickly. And then Ford released their earnings today. So just want to take a quick look at a few things there and some of their comments on the earnings call. Here we can see their financial results. So these were a little bit below expectations, particularly in terms of earnings. I think their stock is down about 5% after hours, at least it was when I last checked. Most interestingly for us, though, is taking a look at the EV business. So as we know, Ford, one of the very few that separates this out, we can actually see their profitability. So far, year to date, they've lost $3.1 billion in earnings before interest and taxes from the EV portion of the business at a negative 73% EBIT margin. So continues to be tough profitability-wise. Here, in a little bit more detail, we can see the quarterly results. So as we previously knew, unit sales for the third quarter were up very marginally. Remember, there was an impact this quarter from downtime for the F-150 Lightning. That's going to impact all these buckets. But revenue also basically flat quarter over quarter. EBIT loss increasing. So again, driving that to $3.1 billion year to date, but $1.3 billion loss specifically in Q3 on $1.8 billion in revenue. Obviously not very strong. And specifically in Q3, the EBIT margin, negative 76%. So losing huge amounts of money here. Of course, that is to be expected somewhat as they ramp up production. And again, this is going to be impacted particularly this quarter by that downtime that they had on the F-150 Lightning. The question is, can they kind of get over this hump where they're losing money and start to make this at least less significant in terms of the losses and eventually flip that into profitability? I think they've said in 2026 they're looking for low single-digit EV margins. So EBIT, EV margins. So a long way to go for them to get there. They did say in terms of the overall business, just real quick, that because of the UAW strike, they have withdrawn their guidance for 2023 for the fiscal year. I think GM did the same. So that probably impacting things today as well. But more interestingly for us, they provided updates on their earnings call about their EV plans. So their CFO said that Ford is going to be postponing about $12 billion in planned spending on manufacturing capacity for EVs, including a second planned battery factory in Kentucky. He did note that their Blue Oval City manufacturing campus in Tennessee is going to continue as planned. So they are still going to be making investments, but delaying a significant portion of it here and saying, quote, "The customer is going to decide what the volumes are. Ford is able to balance production of gas, hybrid, and electric vehicles to match the speed of EV adoption in a way that others can't," end quote. So you could have copied and pasted this into GM's earnings. This is almost exactly what they had to say. I guess they both feel that they are able to do this in a way that others can't. But again, as we had talked about, with flexibility comes opportunity cost in terms of real costs actually. So opportunity costs and I think real costs, you can't just have flexibility at the cost of nothing with manufacturing. So, they're trying to, I think, spin this as positively as possible, but looks like pretty significant slowdowns in EV plans for GM, for Ford, and for some others. Hyundai kind of going the other way, but for the most part, significant delays. Lawler also said that, quote, "We're not moving away from our second generation EV products. We are, though, looking at the pace of capacity that we're putting in place. We are going to push out some of that investment," end quote. So, story that has continued to repeat day after day after day over the last few weeks. Delayed investments, less aggressive plans for EVs from automakers kind of across the board. And it's not like we haven't seen that sort of similar conversation from Tesla. Obviously, Tesla has also slowed down their plans a little bit too, per the Q3 report and earnings call. But we're talking about things that are very different in terms of context. These companies are slowing down their plans before they're even at a place where their business is starting to even become profitable. They haven't even achieved that type of scale yet. Tesla is slowing down because they just want to continue to be free cash flow positive on their already significantly profitable, significantly scaled business. And the longer that disparity exists, the more that benefits Tesla, because Tesla's going to continue to have positive free cash flow. These others are going to continue to have negative free cash flow because they're not yet to scale. The longer that you go in that sort of an environment, Tesla is going to continue to make these investments with that free cash flow. Others aren't going to have that luxury, and it's just going to widen that gap. So yes, we are seeing a little bit of a slowdown for Tesla too, I believe. But again, these are very different in terms of what they mean for each of these businesses. Each of these businesses meaning Tesla versus companies like Ford or GM, legacy EV makers. So although this period is challenging, I think ultimately this is something that probably increases Tesla's competitive advantage, or the gap between Tesla and the rest that are making decisions to delay things to even get to where Tesla is today. We ended up in this situation in large part because this already happened, right? This is just a repeat of what had already happened, where others were too hesitant, too slow to make these investments, not wanting to commit. Tesla going all in and getting to where they are today, and that's part of why it's so tough for these other companies at the moment. Tesla is in large part applying a lot of the pressure that we're talking about here. So anyway, significant update from them for Ford. Mercedes also gave an update today talking a bit about EV plans. They shared a little bit on that. So I believe they reported earnings today. Yeah, they reported a decline in profit and revenue. So although we've been seeing a lot of automakers still post pretty good results because last year was a little bit weaker, Mercedes did see a drop. That reflected in their stock price after hours. They did talk a bit about EVs. So their chief financial officer described the EV market as a quote-unquote pretty brutal space and said, "I can hardly imagine the current status quo is fully sustainable for everybody." So it just goes to show that although automakers right now, like Ford is a great example, maybe are pricing EVs in a way that is similar to Tesla, it's, as he says here, hard to imagine that that's fully sustainable for everyone. Over time, they either need to scale and get those cost advantages that come with scale, or they need to raise their prices or just cut the business completely. They can't do this forever unless they just want to keep losing money for nothing. So we're at that sort of inflection point right now, and that inflection point just kind of happens to be getting added pressure from the macro environment, high interest rates, all this sort of stuff. So fascinating period of time, and we'll continue to keep an eye out for these type of updates. And then lastly for today, we also heard a number of interesting things from Hertz on their earnings call. So we've, of course, we're aware of the significant order for Tesla vehicles that Hertz has placed that led to a nice rally in the stock in years past. So right now their business is a little bit more challenging. Their stock is down significantly after reporting earnings after hours today. And part of that was because their EV fleet, which is 80% Tesla vehicles, has impacted their financials a little bit here in multiple ways. So they say that first, while conventional maintenance on electric vehicles remained lower relative to comparable ICE vehicles, higher collision and damage repairs on EVs continued to weigh on their results, negatively impacted EBITDA. They say that for context, collision and damage repairs on an EV can often run about twice that associated with a combustion engine vehicle. And they say that second, where a car is salvaged, they must crystallize at once any difference between their carrying value and the market value of that car. So the MSRP declines in EVs, primarily driven by Tesla, have driven their carrying value, or have driven the market value lower than their carrying value, which they then need to recognize for any of these salvaged vehicles. So as they do that, that's going to impact their financials as well. So basically Tesla's price cuts putting pressure on the residual value of the EVs for Hertz, which I'm sure that played into their calculation when deciding to make that significant investment. So that part is interesting. Obviously not a super exciting update. So there were some other mixed commentary throughout here though. They do say that the share of new electric vehicles in the US is growing. Studies of current EV ownership evidenced lower incidence of damage and collision than for ICE vehicles, not higher as we are experiencing. So they're saying that there's a little bit of a difference in what the sort of standard market is versus what they are seeing. They say that they believe those trends will converge. So their hope is that this is not something that persists, but is rather, I don't know that they attributed it to anything in particular, but something that they don't expect to continue very long term. So that's, a more positive take on some of the things that they had said up there. And bear with me, there's a lot of stuff I've highlighted in here. They also say that over the next several quarters, they're going to continue increasing the number of electric vehicles into the rideshare fleet. So it sounds like they're moving things from leisure, which my understanding of it just from context reading through here, I think that's sort of their normal rental business. They're going to move EVs from that into the ride-sharing fleet. They say that they're doing that to simultaneously tighten the EV supply in that channel and more accurately match the fleet to demand. So it sounds like they kind of over allocated EVs into, again, leisure here, and are shifting those into rideshare fleet, which would be their partnership with Uber that we've talked about on a number of occasions. So trying to basically right-size that, which means we should probably expect a little bit lower, growth in terms of Hertz's EV business over time, or at least in the short term. And then kind of the last thing from Hertz, they said that over time, to the extent that we take on more GM vehicles, as an example, they'll be buying all forward EVs at an appreciably lower price point than they were when they bought all the Tesla vehicles. So that's going to be driven by opting for non-Tesla EVs or from Tesla, which has significantly lowered their price. Their point here is just that as they purchase more EVs in the future, they are lower priced and shouldn't be subject to some of the negative impacts that they're seeing here in terms of residual value, since the starting price is obviously lower. They also say that they think that there are elements of those cars that will likely speak to lower incidence of damage, but they think more importantly will speak to lower costs of parts and labor. So this is a particular point on Tesla, again, not something that's positive here, but they're saying that for Tesla in particular, that they think that that's part of what is driving their repair costs to be a little bit higher. They say that, remember, for the likes of GM and other OEMs, there's decades of establishment of a broad national parts supply network. There's an aftermarket of parts that is less mature in the context of Tesla. So again, not something positive, but something that I thought was interesting and definitely wanted to share. As they had said previously, this doesn't necessarily reflect, perfectly in terms of what it would be for the consumer market, but still an interesting update for them. It sounds like they're going to continue to push forward on EVs, just this is part of the learning curve that they have to undergo. And again, not necessarily a perfect match for what the consumer market would be. So, hate to end on a more negative note there, but nevertheless wanted to pass those comments along because, they definitely attributed a part of the earnings miss, at least, to the impact that Tesla has had. A lot of that being driven by the price cuts from Tesla. But again, they do continue to plan to increase and continue to grow the EV business, just probably a little bit less aggressively than what they were doing, in 2021, 2022. All right, that'll wrap it up for today then. So as always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on X at Tesla Podcast. And we'll see you tomorrow for the Friday, October 27th episode of Tesla Daily. Thank you.